My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is John Roque, someone who has effectively been in my life for a very long time, which we'll get into. John, I appreciate the time here. For those who are not familiar with who you are and your background, just set the stage for the audience on your experience, what you've done, how'd you get involved in markets?
Okay, Michael, thanks a lot. Good to be with you again, and always an honor to get the invitation. I've been in the business since 1990. I first worked for a small firm in White Plains, New York, for a guy named Ken Safian. He was the publisher of a number of research reports and ran Safian Investment Research. And then I went to work for 4 years at Lehman Brothers with a guy with whom Michael Guyad is very familiar, Steve Shobin. Steve Shobin and Mike Guyad Sr. were former colleagues and very close friends. And so I worked for Steve for 4 years, and I left there, and I went to work for Arnhold and S. Fleischroder, which I thought was just a wonderful place to work. John Arnhold is still a friend and was a great leader, a great boss, and just a wonderful place for my career. And I left there because the French kind of screwed it up, and I joined an ill-fated firm by the name of WJB Capital. You guys can do your due diligence by looking up what happened to it, but suffice it to say, I was able to then join Soros Fund Management for 4 years after that. I thought Soros was just a wonderful place to work. If I could do it again, I would. I thought it was great people and run very well. I learned a lot there. And I figure it was joining there was kind of like being asked to play basketball for Dean Smith at North Carolina. You must go. After that, I left with some people from Soros to go to Key Square Capital Management. Then I spent a little while at Wolf Research for 2.25 years. And I been with 22V Research, which is a macro research boutique, since October of 2021. I'm very happy to be here. Started by 4 guys who left ISI, which was, of course, run by Ed Hyman and still is run by Ed Hyman for all these years. And I'm a technical guy through and through. I believe price tells the truth for the most part, nearly all the time, although there are some times when it does not. But we have to pay attention all the time. I also try to use technical work when looking at other time series data, like the CPI and the PPI. And I try to look at things with a little bit of a cynical eye, because I think most of what we hear, either via the mass media or via most of the street research, is not well thought out. And with that as an intro, Michael, it's great to be with you again.
Has research changed over the last several years and decades? I mean, you've got the sell side experience, you got the buy side experience. Has anything changed? I'm just curious. Has research changed in terms of the way it's presented and the way it's received, and in the way that the data is accessible? And has research become easier or harder? Because arguably, the more accessible things are, the less edge you might have.
I think it's changed a lot. I think it's a good question, challenging question. So I remember when I got into the business, strategists would, of course, have a model portfolio that included cash and some measure of commodities, or let's say some alternative, maybe real estate, which was not an S&P sector. No strategists do that now. Nobody's advocating cash, and certainly nobody is advocating anybody put some percentage of their portfolio into commodities. At least almost nobody would. I'm not a strategist, but I've been advocating that since December of 2020. That's number one. Number two is, when I got into the business, if an analyst or a strategist got you out within 10% of the high, that was a good call. That was a really good call. If some analyst or strategist got you in kind of 10% after a low, that was a good call. It was a really good call. I don't think people see it that way anymore. I think you have to be right immediately, or you're thought of much less than you were when they first started to talk to you. In addition, it is very, very rare to find sells, real sells, on what are technology stocks. Very rare. You can go to look at even HubSpot, you can go to look at Amazon, Apple, all these stocks. There are no sells on them. And the stocks are in a ton. So it's quite likely that there's a tremendous echo chamber. And that's the reason that the buy side does their own work to a great degree, because they have to check on the sell side work, which for the most part, for those particular items, they're kind of echo chambers of what they're hearing from the investor relations department. And they want to have access to the firm, so they're reluctant to send out a report with a negative opinion or negative commentary.
That point about being spot on and kind of the higher standard now is interesting. I assume that that's driven more by short attention spans and shorter time frames, right? It used to be the case that the average holding period for a mutual fund, for example, was 4 years. Now I think it's something like 7-8 months. And for ETFs, obviously, it's a lot shorter of a time frame. How do you deal with that type of standard, which is unrealistic by clients, right? Because You're right. People expect you now to be spot on the exact mile marker that some kind of event might happen, forgetting that if you slow down in advance, that's still fine.
So I've tried to use this kind of trite line where I say I'm a trender, not a trader. And so I always kind of couch it not to deflect, but just to be totally clear. I am not a trader. I am a trender. I'm trying to get the major trend right. And I will suggest to you that there is some change afoot and we should be preparing. For example, there was a big change afoot in NASDAQ whereby the 7 big stocks kept the price index aloft for a long time, despite the fact that the internals for NASDAQ had been weakening for many months prior to that. So to me, it was kind of an amber flashing light to say, listen, I know price has not corrected on the major index, but there are a lot of internal things occurring where you can get short, not the index, but individual stocks. And I think people kind of appreciate it if you tell them immediately what you are and what you are not. That way they cannot expect something from you that you can't provide. And I think for the most part, and I'm guessing you will agree with me on this, that everybody in the business thinks they're much better at trading than they actually are. And so I'm always amused how most people will tell you about their wins. I got this one right, I got that one right, but it's very rare to hear someone kind of lay themselves at the feet of the court, so to speak, and use a mea culpa and say, listen, I blew this one, I got it wrong. That to me lends a lot of credence and gives the person who says it some more, gets them some more respect and gets them some more, people are more interested to speak with them because they're willing to admit that they did make a mistake.
But in fairness, you can have losses and it not be a mistake, right? And I say that from the perspective of somebody who's been in the business for a while, as you have. Help me with how to communicate the idea that markets live in much larger time frames than the way that we think about it.
I think that's right, Michael, that markets do work in larger, longer time frames. So we are, unfortunately, all of us in the business want to get it right immediately. I get messages from investors, clients all the time on Bloomberg or email for them, and they say, what's timely today? And I kind of think it would be really lottery-like if I could get it right today. I'll tell you just before I answer your question that I got something entirely wrong over the last few days. So I had an investor who I pitched to them shorting Ryder, letter R, Ryder Systems. And I was in a webinar on Friday. I came out of the webinar, got back to my desk, and I saw a news item that said, there's some action on Ryder. It surged on a takeover offer. And, I felt really terribly because I spoke to this guy about shorting it. And so I quickly contacted him and said, I blew you up on this. It's my mistake. It's my fault. I'm totally wrong. Here it is. And he didn't get back to me right away. And I took a walk to go get something to eat. I came back and he came back and he kind of laughed at my message to him. And he said, I got really lucky. I covered it at the open. And so I'm glad he got lucky. It didn't make me feel any better. Oh, it made me feel a little bit better because he didn't get hammered on Ryder going up a ton. But that was an example of something that did not work immediately, although the setup was right. And so to make a broader point and follow on yours, maybe your strategy isn't working right now because in the grand scheme of things, this right now is the moment that matters where the strategy can't work because everything's going against it. But 7 out of 10 times, 8 out of 10 times, or 6 out of 10 cycles or 7 out of 10 cycles, that strategy is going to work. You just happen to be caught in a year where both bonds and stocks are not working at the exact same time, which is exceedingly rare. So I don't know that I changed my strategy because I happen to be caught in an exceedingly rare year. I just say, listen, I'm going to try to do the best I can with my strategy because I know that over time, this is the one that works.
Yeah, it's just hard for people to not get emotional in the here and now. It's funny, right? Because drawdowns really shouldn't matter until the moment you have to actually pull out your money in any strategy, right? Because with long enough time frame, the assumption is going to be that you'll recover from the drawdown. And yet people respond to drawdowns as if they need that capital tomorrow for some kind of life event. And oftentimes I think that's what gets people into trouble longer term. And again, you've been in this for a while. I always make this point that there's this old saying that your biggest drawdown is yet to come, right? In any asset class, which I think kind of explains the bond market. Now let's hit on bonds, and you mentioned the trender part of this. I named this space purposely "inflation now, deflation later," because that's my personal view. Could obviously be very, very wrong, but I do believe that with leverage as high as it is, you can't necessarily inflate your way out of it over a longer term time period, and that leverage at some point becomes a deflationary force on top of demographics and all this. Talk about the way that you're seeing the market's view of inflation here, and is it more of a short, intermediate type of situation? Is it a longer term situation? We'll talk about commodities too, but I want to hit first on inflation.
Okay, so sent out a note to clients, maybe an hour ago, and it's entitled "Back to the Future." It's the second time in the last 2 weeks that I've used a Michael J. Fox movie to analogize the market environment. The first time I did it was the movie entitled Doc Hollywood, which if anybody's seen it, they'll know that Michael J. Fox plays a guy named Doc Stone, who's really rash and brash, and he goes against the old-time country doctor, Doc Hogue. And I use that analogy because investors were telling me with respect to the move higher in 10-year treasury yields that it's different this time. And I went with a kind of a Doc Hogue line, which was the bond market never lies. And to be sure, it was a line that was said to me about a decade ago by Robert Soros. He said the bond market never lies. And so far, the 10-year treasury yield is now undefeated for the 15th rate rise in it itself, not Fed rate rises, but the 15th rate upcycle for the 10-year treasury yield since 1974. It is the capo di tutti capi of all market indicators, and it's kind of like Rocky Marciano, who's the only heavyweight champ to ever retire undefeated. The bond market is undefeated. And I think, and I wrote this tonight, I said the Back to the Future analogy is about what I'm hearing sentiment-wise. Most market participants believe the environment will revert to low inflation, low yields, low commodity prices, rising crypto, and rising stock prices. A quick trip back to the future. Such a ride won't be on a souped-up 1981 DeLorean, but to quote Prince, it would be a return to a world of never-ending happiness. You can always see the sun day or night. And then I finished the comment by saying, make no mistake, except for a few blasphemers, almost nobody believes inflation, yields, and commodity prices will remain sticky or stubbornly elevated. I do. So, to then put some meat on this, I thought last year, and this will sound hubristic, but I'm going to leave it out there like that. I don't think it was. I just thought it was something that I did that was fairly easy to do. I just started to count the number of months that the PPI was above 6% year on year. And every time I counted another month, Jay Powell kept saying it'll be transitory. And I said to myself, nobody at the Fed is doing the counting that I'm doing. Again, this is not tremendously insightful. It's not even a home run. It's just that I was counting the months. Right now, the PPI has been above 6% year on year for 14 straight months. This is the third longest streak over the last 70 years. The prior streak, the first longest streak was 34 straight months, and then the second longest streak was 59 straight months. Of course, both of those streaks happened from the early 70s until the early 80s. There was an intervening period where for 14 months, the inflation rate dropped down to about 4.3% on average. Hardly comforting, but lower than it was. But you had 34 months in a row and 59 months in a row of 6% year on year monthly figures. And so I said quite recently, I don't even know that anybody at the Fed is aware of this, because if they were aware of this, they might consider that their inflation call to be lower, or the street's inflation call to be lower, might be a little bit misplaced. And so I did the same thing with the CPI. So the CPI has now been above 4% year on year for 13 straight months. Oh, and before I forget, just to alert the listeners, PPI has now been above 10% month on month, 10% year on year for 9 straight months. 9 straight months of 10% or more gains in the PPI. So now the CPI has been above 4% year on year for 13 months in a row. Again, I don't think anybody at the Fed was paying attention, because this is now the fourth longest streak since the early 50s. You had a 13-month period in the early 50s, but then you had a 40-month stretch. You had a 117-month stretch. I guarantee nobody Nobody on the street has counted these numbers. 117 months from the mid 70s through the early 80s. You did not see lower than a 4% print each month for 117 straight months. It's almost ridiculous. It's almost too fanciful. And then you had in the late 80s into the early 90s, 38 straight months. Here we are at 13. And so I look at this and I say, once you get past this certain level, this threshold, you stick at a higher inflation rate than most people believe. And kind of that's what I'm going with. It's not fancier than that. There's no models involved at all. All I did was plot CPI and PPI year over year and count how many months it's been above 4% for CPI and 6% for CPI historically. When you get above these levels here, it tends to stay longer than you think.
All right, so what does that mean for equities then, right? Because that's always been one of the narratives, that equities can serve as an inflation hedge because of pricing power by different companies. But we're seeing, obviously, a lot of volatility with equities as this inflation is surging. So let's say it stays elevated. Do you think stocks can do okay in that environment?
The history shows that when the PPI is elevated, there is always a bear market, except for the early 50s. We came out of World War II, and the early 50s, there was a lot of pent-up demand, and the markets did not look too troubled by anything that happened with a high PPI at that point. But other than that point, there's always a bear market with respect to high inflation. That's number one. Number two is, I've thought that most analytical work did not go back far enough to consider the prospects of what we might expect for equities, et cetera, in this environment, in this type of environment. And I thought the playbook was from the late 60s through the early 80s. The playbook is not from 1990 forward, which is why I think most people have kind of, been troubled by this particular period, because they've been using a 1990 to date playbook and they weren't going back far enough. So I think that there's a regime shift going on now. The regime shift is where the Dow, which I would consider less growthy, of course, than NASDAQ itself, is outperforming NASDAQ. And I've called it the fourth turning. And the fourth turning for the Dow to outperform NASDAQ means that if you just divide the Dow by NASDAQ, you'll see that you're getting a turn in the ratio. The first turn occurred from June of 1972 through January of 1976. The Dow outperformed by 57%. May 1983 through October 90, the Dow outperformed by 90%. February 2000, August 02, the Dow outperformed by 205%. And so I think you're in the early stages of this fourth turning where the Dow is going to outperform NASDAQ, or is outperforming NASDAQ now as well. And a very small look into this fourth turning is if you just divide the S&P energy sector by the S&P information technology sector, or S5 ENRS divided by S5 INFT, or XLE by XLK. And you'll see that you have a turn here in this relative ratio. Now, there's not a lot of data for this because the S&P sectors only go back to 1990. But the turn here kind of corresponds, or does correspond, with the fourth turning in the Dow to NASDAQ ratio, and the prior turn in 2000 for price corresponded, of course, with the Dow's turn from 2000 into 02. So I think the playbook involves owning natural resource or inflation beneficiary equities. Now, of course, please understand that in a bear market, they ultimately come for you. It's really going to be odd if the energy space or natural resources, which has pulled in here, does not get hit. But I think it's going to be right to buy pullbacks in those stocks and to sell on rallies, technology, and growth stocks.
Okay, now wouldn't that bear market / recession be disinflationary, right? Because the wealth effect is an inflationary force. If you end up having falling asset prices, people feel less wealthy, homes decline in value. That would take a lot of consumer spending out of the equation, right? And maybe do a lot of the work for the Fed. I put out that tweet before that the stock market will break inflation faster than the Fed, right, in terms of behavior. Talk about how that dovetails with the longer term inflation thesis.
So I'm going to politely say I'm going to try not to look around too many corners on this one. I know what I think it can mean, but I also wonder if on the other side of this, that it doesn't mean that the Fed will, provide another dose of liquidity. if it doesn't mean that the Chinese government will provide another dose of liquidity on the other side of this. I don't know. So I don't want to look around too many corners yet. I understand your point, and I won't dismiss it because I don't have enough evidence to dismiss it or to embrace it yet. But I don't want to look around too many corners. And this is the one I'm just concentrating on right here. I think it would be too much for me to make that leap yet because I would need to see evidence of it occurring, and I just don't have that evidence yet.
No, that's fair. And it's just more of a thought experiment for me, right? Because look at how much wealth has been lost off of the highs, right? Not just in the Nasdaq, but obviously in the bond market. That's a lot of money that suddenly got sucked out of the system, and the Fed only barely hiked rates, right? Which is just kind of interesting. And now I'm curious also, John, about what your thoughts are in the currency space, right? Because that's been another disinflationary force, although obviously it hasn't really mattered this past 12 months. But the dollar's been pretty unrelenting on the upside, and classic market analysis would argue that that's a way of tightening liquidity. Talk about what you think is happening here with the dollar for a moment.
Well, the dollar remains nearly universally strong. I think the euro dollar is going to spot 8.5. I want to be long dollar against India rupee. I want to be long dollar against Aussie, so Aussie US lower. I want to be long dollar ZAR. The dollar is universally strong, and I thought that there was a great conceit earlier this year among hedge funds that there was going to be a de-dollarization to occur. And when I heard the the argument or the thesis, I would look at the charts and I'd say, the dollar doesn't seem to agree with that yet. So I thought it was a little bit curious that people were jumping the gun on a de-dollarization. And it doesn't matter to me what occurs. I just want to know if I can figure out how to benefit from it or to avoid taking losses. And I just said I just didn't understand which currency would take over from the dollar. I thought it was way too premature. And to your point about dollar strength, I understand that in dollar strength there really should not be a great commodity advance. And I will tell you, I'm troubled by gold's recent softness. To put it politely, I would probably tell you something a little bit more profane if we were talking on the phone. But I'm a little bit troubled by gold softness. And I know over time that there has never been a real sustained commodity bull market without gold at least participating. It doesn't have to lead the way. And of course, gold is suffering a little bit here, of course, because the dollar is strong. Gold had held up into some weeks ago despite dollar strength, but gold's had its greatest bull markets when the dollar's been weak. So I think the dollar being strong is another negative here. And it's hard for me to believe that China and Japan, either wittingly or unwittingly, can have their currencies devalue at the same time and dollar strength continue to occur without some problems developing further.
Yeah, no, I would agree with that.
Okay, Joe, thanks for the question. I'm going to, again, kind of, politely skirt your question only because I don't have enough information about that. I've heard others say what you've just said. And so if more people say it to me, I tend to, remember it and pay closer attention to it. I'm willing to understand or believe that could be occurring, but I don't know how to address it. I don't know what that means for me in terms of where should I put my stops. I don't know if it means that I should be less aggressive or more aggressive because it is artificially plateaued. I just don't know how to do it. If it's going to be tremendously important, then maybe gold and silver are really unable to rally here, but I just don't have the input to provide you with a great answer. So I'm not dismissing it because I don't want to answer it. I'm just not answering it because if I gave you something here, I'd be making it up.
No, and in fairness, I mean, I think at the underlying thread there is the idea that there's a degree of manipulation in prices with gold and silver. My response is always that there's manipulation in literally everything. I mean, every single asset class has some degree of manipulation. I don't know if that's a fair characterization.
So I have to tell you, I have been vocally and repeatedly, bullish on both gold and silver over my history in the markets. And I will tell you seriously that I thought silver was going to try to turn in March and April. I really thought it was going to try to turn. And I thought gold was giving us its clues, especially with the push upward in March. And then you got a pullback that held at 1900. I said, okay, gold will consolidate here above upward sloping moving averages. And my goodness, it'll set itself up for a more important move to a new all-time high. And I got to tell you, both kind of disappointed me. I realize that makes me wrong because I wanted them to do something. But their setups were not traditionally setups that should have failed, which makes me a little bit more cautious about their prospects. I mean, gold's setup was a bullish setup. Why did it fail? I hate when you have fake breakouts and you have failures from fake breakouts. Those are really, really harmful, and they usually are harmful in a very quick manner. So I got smoked because I thought gold was going to push higher or consolidate at least, and I thought silver was going to be in a great position to work higher, and they didn't do it. So maybe that's a bigger mistake for me, but it was kind of both fooled me, and that tells me I probably should be a little bit more cautious about them here, or they're really going to have to show some chutzpah or colognes, depending where you grew up, to get me interested again.
Okay, now in fairness, John, I always make this point that somebody can be both bullish and bearish at the same time. It just depends on which time frame you're looking at, right? Because you mentioned that rarely do you see commodities as an asset class do well if gold isn't. Given that there's been so much bullishness in a lot of these spaces and momentum in the commodity space, do you think that there's a risk that it could surprise people and suddenly start aggressively selling off? I agree with you on the longer term thesis, right? When you look at things like the commodity to equities ratio, that's coming out of a very long base and there's a secular trend there. But oftentimes it's the sequence of returns that causes people to mess up, not necessarily the endpoint.
So I will tell you, just by looking at the setup, and I'm going to just give it to you straight because I wrote about it a lot. In the late part of 2021, I thought that gold was setting itself up when it was at $1,900. I thought it was really setting itself up. The moving averages were all in gear. Gold was slowly improving. Momentum was slowly improving. And I thought we were going to have a move to a new all-time high. And, it got right up until the 2020 high. But the setup was such that, okay, maybe you should have gotten some pullback, but you shouldn't have gotten a failure below support at 1900, and then you're testing support at 1800. I got to tell you, this is very worrisome to me. And it would not surprise me if gold got back to the bottom of the range at 1700. It really would not surprise me. And I'm not negative on gold, certainly not negative on commodities. But this would really be a surprise to me and would be an amber flashing light that maybe the turn in commodities relative to other items, and when you have a turn in commodities, the commodity bull market usually lasts 15 years on average. This is something I would have to reconsider. So I think that's a great point. And I'm certainly no pro on what will be needed to electrify or decarbonize. But it was curious to me how other industrial metals did well, but silver did not. That was really curious to me. Aluminum went up a ton. I know copper didn't really go up a ton, but certainly copper outperformed. And I know there was a nickel squeeze, but nickel was set up regardless of the squeeze to do tin, zinc, lead. I mean, these metals all did well. Why the heck was silver sitting it out? That's rhetorical. I don't know that. I certainly don't have the answer, but why was silver sitting it out? Now, it could be for the reason you asked me at the beginning with your first question, but again, I'm not prepared to say that. But I was saying to myself, what's holding silver back? And then when gold started to go, late last year into what was the spring of this year into March, I said, my goodness, silver's got to come on. It's got to come on. And it didn't do it then either. And so not only is silver didn't work when the commodities were going great. Silver didn't work when there was supposedly deflation. Silver isn't working when there's inflation. I want it to work because I'm biased to commodities or assets other than growth stocks. But I mean, golly, silver, show some life here. Show some Coleone. I mean, it doesn't do it. Neither does gold. Why can't they work? That's rhetorical. I'm not whining. I'm just asking passionately, why the heck aren't these things working? Yeah, I think it could very well be the case again, but those are, I'd like to be able to say this happened in a prior cycle. This is what we might expect, or I have some data to suggest that, this is where silver has bottomed before in a similar part of a prior cycle. Those are all good inputs that you're sharing with me, and it's hard for me to dismiss them, and it's hard for me to accept them. So I'll just kind of put them right in the middle. I just don't know if that's the case, and it's very difficult to prove it. If it is, and I will tell you from speaking to institutional accounts, which is my day job, if it's hard to get somebody to buy a gold stock, it's excessively difficult to get somebody to consider buying a silver stock. Almost nobody will buy physical gold, and you could cut that by 99% to say how many people would buy physical silver. So to me, it's a very small subset of investors who would be involved in the silver space. The subset of investors who would be involved in gold is considerably bigger, but it's very small on silver, really small.
But this brings with it a bigger question, John, and I've heard different opinions on this. I have my own, but really, I think at the core of the question is cash as an asset class, right? Because it's like I put that tweet out earlier, which got a lot of engagement. Ironically, holding dollars has been the best inflation hedge, right? In this period. Do you view cash as an asset class that people should consider, or as a residual of the investment process? And I say that because you and I both know that a lot of these studies on market timing show that market timing doesn't work, and it usually doesn't work because cash is the risk-off asset.
So I do think cash is an asset, number one. I do think it's an important asset. And I do think that I'm really not a fan of benchmarks. I'll tell you why, because most benchmarks are weighted to tech. And to beat the S&P over these past several years, you had to have more than 40% of your assets, 40% of your stocks in tech, more than 40, because the S&P is 40% weighted to tech. I've done the adjustments. So I'm really not a fan of benchmarks. That's number one. Number two is you can't eat relative performance, as Jean-Marie Eviard said so many years ago. So I think it's very difficult for most people to measure themselves against benchmarks if they're not going to have more than 40% of their stocks as tech. That's number one. Number two is I realize going to cash is a very difficult position because it's two decisions. You're going to cash and then you have to come out of cash.
But just before you emphasize that, because I always make that point. You're exactly right. It's two decisions. You have to get it right twice.
You have to get it right twice. It is a very difficult decision. And most long-only investors have a mandate where they cannot have, and I'm going to throw this number out, I think it's pretty right, they can't have more than 5% cash, and that's a giant number to them. They don't manage cash, they manage equities. So most people don't have cash at all. They are selling one to buy one. But I do think cash is an important hedge. And so far, I know this is extreme and extraordinary, and it's ridiculous for me to say it, but it's proven the most important one so far this year.
Okay, so you alluded, John, to the point that we haven't really seen anything quite like this environment. And I keep making this point that even in the 70s, you didn't have a period where week after week after week, stocks and treasuries sell off. The sequence of returns in terms of stocks and bonds, I know this because I have strategies that are meant to try to take advantage of the historical relationship between the two asset classes. You haven't really seen anything like this. Now, when you're in a really uncharted cycle, what do you try and do to try to identify if the cycle's changed? I know that's the real big question, right? That nobody can ever really answer. How do you know if a cycle's changed? But what kind of things would you look out for to see if this anomalous environment is coming to a close?
Well, I want to just go back and put some data behind what you said. If you go back to 1976, the last 8 times the S&P was down in a calendar year, bonds finished the year up, which is essentially, Michael, forgive me, your strategy that you mentioned. But 2022 is the anomaly. So 1977, 81, 90, 2000, 2001, 2, 8, and then 18. The S&P was down total return, but the Bloomberg Barclays U.S. Aggregate Index total return was up for those years. 2022 is the anomaly for both to be down. And then how do we know that we're in a kind of a cycle change or regime change? I think we do our best to kind of look at relative ratios, which can help. So some relative ratios that I pay attention to are the Dow relative to NASDAQ. I've used commodities relative to the S&P for a long time, or commodities relative to Russell, bonds relative to all of the above. And so I think those help us develop markets relative to EM markets. Of course, I think using bonds against anything else is a great relative ratio in addition. But those are some ratios that I think will help us. These are not perfect decisions, and we're trying to make them less imperfect by using these small indicators. And I think you can get a lot of confidence by looking at these longer-term relative ratio changes because they don't happen that often. And I'll tell you, this is just one example, but I would guess that if this were the early 80s, when Volcker came in and the inflation rate peaked and the rate on the 10-year Treasury yield peaked, most people would have been saying at that time, nope, inflation's coming back. Nope, higher rates are coming back. And yet the turn had been made. And I think it's the opposite here, where most are saying, Nope, deflation's coming back. Nope, lower yields are coming back. But yet the turn has been made. And then I think that's part of the whole regime change, is that it is very difficult to identify these changes as they're occurring. Most people only identify them in retrospect, which kind of means after a few years of trend change. It's very rare to identify them as the trend is actually changing.
Yeah, no, I'm glad you said that. That's something I always often say myself. Is the problem with cycle changes is you only know if the cycle's changed 2 to 3 years after it already has changed, right? It's kind of like the momentum anomaly, right? For momentum to be an anomaly and to take place, there has to already be momentum, which means you miss some of the best returns, right? And so more of a kind of thought experiment.
So you're telling me that you would have sold some stocks, and instead of going to cash, you would have bought the UUP? So I don't know the answer to your question if it applies to UUP or not. I don't know. I don't know the vagaries of the Invesco, what their holdings are. I
think when you're sitting in cash, you're in cash relative to cash. But if you're in something like UUP, you're really short the euro, which is the bulk of it, right? Which I think is kind of the question. Okay, so we touched on commodities, which touched on bonds. Let's talk about sentiment for a moment, John, because Eric Balchunas, who I know from Bloomberg, put out a tweet last week showing that ARK had its biggest inflows in a year. And when I saw that, I retweeted it with a comment saying that's not typically seen at the lows. There is this real remarkable, stubborn, buy the dip, no despair mentality in these innovation stocks, in these gurus, and in the cryptocurrency space. From your experience, how do you factor in sentiment to your analysis in terms of, again, the sequence of returns?
So I think your opinion about ARK is, with respect to fund flows, is my opinion about ARK. So in April of 2021, I wrote a note when I was still at Wolf entitled "Raiders of the Lost ARK," ARKK, of course. And I thought that was kind of the first salvo of where it had come down from February. And then it going sideways, I thought that, this was prepared to deteriorate. It actually reminded me then of the way NASDAQ had declined in the year 2000. Came down sharply, tried to bounce, and went sideways, and then went down. So I think that cults are hard to break, and the fund flows determine that. Now, I happen to think that ARK was, and maybe it still is, a bubble. And if I'm right about ARK being a bubble, then most bubbles don't pop until they're down about 90% from their peaks. Now, I don't wish it. I don't have any ill will toward ARK, but most bubbles don't stop going down until they're down about 90% from their peak. If that's right, then maybe ARK goes to about $20. I don't have any skin in the game, but it's remarkable to me that despite the fact that it continues to do poorly, the fund flows remain, fairly robust. And 10 of 13 weeks recently showed inflows, and ARK was down about 36% over that time. So just because it has inflows certainly tells us that prices don't have to go up. In fact, they can go down. And I think this is part of the zeitgeist of the era. Most people have been convinced that stocks really only go up. And if they go down, they only go down for a little while. And it's your line, there are no gurus, there are only cycles. And I think there was a cult of personality around, ARK and its foundress, and it was perpetuated by the business media. And I'll tell you also, when her face was superimposed on a T-shirt with the Barack Obama hope slogan underneath it, I thought that was it. And I said to myself, this is really not the way our business is supposed to work with respect to personalities. And that, combined with topping price action, suggested to me that it was going to have a problem. And I still think it's going to have a problem. I'm not a buyer. And I think the fund flows are more indicative of not necessarily buying things that are cheap, because I don't think it's cheap. I think it's just the cult is hard to break. It's the cult of personality.
I'm so glad you said that, because I feel like that's what is really different than the past, going back to that first question about how research may have changed, that you have these cults in investments where people almost define themselves by what they're investing in. I don't recall, even with my father, in my conversation with him about markets, that ever being a market factor. I don't know. What are your thoughts on that?
Well, I also thought, and forgive me, I know I'm in the business of research, so forgive me for saying this, please. But it was also odd to me how her firm decided to give away their research for free. I mean, if you're giving away something for free, and if I'm getting something for free, it turns out I'm actually being suckered, I think. Because if it were for free, if it's free, I don't know how much it could possibly be worth. And I thought that was part of the hook for her investors, that they thought they were kind of, let into sancto, kind of the inner circle on this thing. I think it's a little bit strange, but I think it's also part of the zeitgeist that there are so many outlets now for people to speak. And I happen to be on one of them now, and I'm thankful for you to have me on. But I just think it's part of the cycle, in that investors or investment managers, PMs, are in some respects celebrities, and that's probably not such a great handle. I think you said it more eloquently than I can, or than I have. I think that's a really important question, and that's the sort of question that I ask all the time. I ask of myself. I ask of others in the business. I think you're spot on. I really do. I will tell you though, it's very hard, really hard, to kind of coderize or to figure out what sentiment is at any one time, because it is so diffused as opposed to what it was historically. For the most part, during the early part of my career, you kind of looked at Barron's, because that was the Saturday read. Now, we get sort of reports all week long, and Michael has this great space, and George Noble has another great space. So there's a lot of ways to get sentiment. I don't know that it is as easily applied as we like to think it is, but there are some times when you really do see it clearly. And I don't know you and you don't know me, but I think you're seeing it clearly.
Okay, now let's talk about sentiment in the here and now, because the opposite end of that is there seems to be a hell of a lot of despair in a lot of stocks that have gotten decimated since February of last year, right? When you look at the percentage of NASDAQ stocks trading above their respective 200-day moving averages, you look at AAII sentiment surveys. I mean, it is true that there is a hell of a lot of negativity underneath the surface, even though the averages, while down, are not down like '08 type of magnitudes here.
Correct.
Right. So talk about that distinction.
Okay, so I think you're absolutely right. For a year, there's been two stock markets. For percentage of stocks above their 200-day moving averages, for NASDAQ peaked in early 2021 at 92%. Its most recent low was 15%. As of Friday, it was 16.3%. Usually good market lows, bear market bottoms happen with this indicator in the single digits. The same indicator for NYSE stocks peaked, this may shock many of your listeners, in December of 2020 at 88%. So really the internals have been deteriorating since December of 2020. The most recent figure shows this at 22%. Again, good market lows, bear market lows happen with this indicator in the single digits. The same is true for the Russell 2000 version. So, we're shy of that. It doesn't mean that you can't rally. Now, on Friday, for those of you who are keeping score at home, which was said a lot when you used to keep score at home watching ball games on TV, there was a 90% up volume day for the New York Stock Exchange. So more than 90% of total floor and total NYSE composite volume happened on the advancing side. So, that could be a start. I do think the market can rally. I wouldn't surprise me to see it rally to its recent breakdown level for the S&P. And I do think there could be a rally for NASDAQ, but I think it's a bear market rally. And until proven otherwise, that's what I'm going to stick with. I don't think we've made a good bear market low. Although Michael's right. We've been deteriorating internally for more than a year and a half for the NYSE internals. So it's been a while. It's just that the major averages have only sort of complied. So I think it would be important to pay attention to what is going on with the 5-year Treasury yield. I think the 5-year might provide us good clues as to, let's say, economic activity slowing, or maybe the Fed's rate rising cycle will not be as long-lived as it is already seemingly, in quotations, priced in. I will tell you, however, that most investors that I've spoken with or speak with do not believe the Fed will do every rate rise that they are slated to do via the Fed funds futures market. So I would pay attention to the 5-year Treasury yield for certain, and I would pay attention also, of course, to the 2-year Treasury yield. Both of those items have made recent highs in early May. They're consolidating a little bit. Momentum is deteriorating, but their trend remains up. My targets for the 2s through 3rd had been 3%, and nearly all of them got to that figure, which probably suggests that I should buy a lottery ticket and also expect some consolidation at the very least for these yields. But I would pay attention closely to the 2s and 5s, and if they roll, that either tells us that the Fed is going to, I believe, not go as far as they're suggested to go, and perhaps it will also provide some clues as to the economy, that it would not be as robust as some of the indicators have suggested to us. I'm going to politely not answer your question. I don't know enough about the mortgage market to sound like I'm on top of it. And if I said something here, I'd be making it up. So I'd rather.
I'll add something real quick about that, because I've gotten that question from people before. I think housing to me is I think it's very hard to view it from the standpoint of trying to time when to get a mortgage, because listen, I mean, you got to live your life every day, and ultimately, if you want to get a house, there's utility to that is probably worth more than trying to time a better mortgage rate. That's just at least kind of my opinion on that.
So I happen to think you're correct that if the market were to strengthen, I likely believe that the Fed would continue their aggressiveness, or perhaps be even a little bit more aggressive. It has been told to us that they want to tighten financial conditions. I do happen to think, though, that the Fed was excessively late in this cycle. For lack of a better phrase, they kind of believed their own baloney, and they were late to change. I don't think that Jay Powell wants to go down as the direct opposite of Paul Volcker, whereby Volcker, of course, smashed inflation, and Powell would have let it run amok. So I don't think he wants to do that, and I think that they're going to do what they can to get that under control. But I believe if equities kind of found their footing and regained a little bit of their fervor, that the Fed would likely continue to be, aggressive or more aggressive. So I believe that we're in a bear market. I believe the bear market is not over. I believe it will continue. I think there are a lot of things suggesting that it likely continues, and we're supposed to be in a Fed rate rising cycle. It's remarkable to me how some have told us the Fed has been aggressive. They've raised rates twice. My goodness. I mean, that's like, the Pittsburgh Pirates winning 5 in a row. I mean, big deal. I mean, the Pittsburgh Pirates have been in a downtrend for 30 years. So I think it's a little bit ridiculous that people have told us that the Fed has been aggressive. But I do think that the environment suggests that we're not in a good space here for equities. I would also make a polite suggestion that if you anybody out there can get the Robert Shiller cyclically adjusted PE ratio data, he makes it available. You can just Google Robert Shiller CAPE ratio data. He makes it available. It's on a Yale website. You can download it into your own Excel. And you can, of course, then take a look at the chart, which is, essentially exactly what I do. And you could plot the chart in your own Excel graphic, and you can find that the long-term average for the CAPE cyclically adjusted PE ratio is about 17. There have been 5 prior cycles where the PE got expensive, which I would call it over 20 or very expensive. So it peaked in the late 1800s at 25, then the PE got to single digits. It peaked in 29 at almost 30, the PE got to single digits. It peaked again in about 1935 at 21, it got to single digits. It peaked again in the mid 60s at 24, and it got to single digits. It peaked at 44 at the tech, apogee in late 99, 2000, and it got to 13. The only time in history where it was expensive or really expensive and did not get to single digits, but it at least got below its long-term average. And then the 6th cycle occurred just before COVID. It peaked at 33. It bottomed at 25. The Fed went crazy with liquidity, as did our government, to help the economy and to help Americans. And the PE then jammed up to 39, which I'm calling cycle 6B. And now it's peaked. So I think that this is the overarching chart that we should be paying attention to as equity investors. Over time, whenever this cyclically adjusted PE has peaked at an expensive level or ratio, it nearly always has gotten below its long-term average. The only time, going back to 1880, which it did not, was just before COVID and then into the COVID low when the Fed jammed us with liquidity. So I'm going to say that was the anomaly, and maybe we should expect PEs to adjust lower over time, which probably means that there's not a lot of upside for equities. in my estimation, and based on the data that I have and the cycles that I've been through as a professional, but all the data would suggest that this is perhaps the most anomalous of all periods, whereby you have many items occurring that never did occur before. I think it was Paul Jones who said in September of 2020, when the balance sheet was growing from 2.5 trillion to 4 trillion, we're witnessing the great monetary inflation. And he said it was an unprecedented expansion of every form of money, unlike anything the developed world has ever seen. And I'm a fan, but my goodness, he was a little bit early. He said it was just shy of 4 trillion, and then it got to 4.8 or 4.9 trillion. So I mean, there was still 20% more of what the Fed did with respect to its balance sheet. So I would say that his quotation was spot on, but it got even greater than he thought it was, and he called it the great monetary inflation, and it became the greater monetary inflation. So I think that this is a difficult period because there are no historical examples that we can go with.
Yeah, I've used that line before. It's the black swan of all black swans.
Yeah, that's a good one. That's a good one.
Right, no, because really it's happening in almost every single asset class, including currencies, right? Almost at the exact same time, which is and treasuries are kind of the real big one in the way that yields have spiked, and things that are supposed to be safe havens have sold off, which again goes back to, in my world, that's what's been so brutal this year. But
right.
Again, for everybody that's been here, please make sure you follow John Roque. Check out everything he tweets and his research. John, I always appreciate your time, your knowledge. Every time I listen to you, it kind of takes me back to being a bit of a kid and hearing Steve and my own father talk about markets. So it's a pleasure for me to, and everybody enjoy the rest of your day or night.